Welcome to the January 5th, 2026 Advance Report for McGowanGroup clients. This week, we're going to cover three important questions. Top surprises of 2025. Then we go to the 2026 conditions of the economy. And we're going to go, what is deep value? Because deep value is poised to outperform, and I'm going to show you some of the outperformances that the investment committee identified. Granted, there were choices that didn't work as well as we thought they would, but I wanted to show you some of the high points of what deep value research is uncovering after a successful year for McGowanGroup clients. Now, the first thing I'm going to cover is crypto, because over the last few years, crypto has been a consistent question from the clients. And I'm going to show you why crypto may not be the best asset longer term. First off, Bitcoin finishes the year at about a -7%. Well, the whole story is it goes to 125,000 a coin. Now it's 88,000 a coin, but you've got some huge leverage built into the crypto market that's just now coming to light. We covered MicroStrategy, which totally collapsed and said, this is a to not to. You don't get any income, and it's only worth what somebody will pay you for that computer file. All right? Now, Polygon. This asset is virtually gone, -77%. By the way, it's in the top 10 cryptocurrencies. This was the way of the future. Trump was going to come in, deregulation, crypto bros go wild. Oh no, you take 9 of the top 10 cryptocurrencies, the average decline well over 20%, and this was one of the worst examples out of the big ones, out of the big cryptocurrencies, not to mention the small ones that just blew up. Now, we go old school. That was the anti-dollar trade. Well, gold and silver have been touted as a good anti-dollar trade. Look at this. It looks like a short squeeze. I mean, the Chicago Mercantile had to raise margin requirements because you had a big old short squeeze. People selling contracts, betting they'd go down, make a bunch of money on leverage. And of course, they had to buy it back when it went against them. Otherwise, they would just implode and they'd owe some money. Well, $200 decline in a single day, but this was a surprise trade. Gold finishes the year up 65%, and little brother silver up 148%. Well, that was the trade of the year. I also think those markets may be at least a short-term peak, because that was a frenzy that got preempted by Chicago Mercantile raising the margin requirements, so you didn't have all that leverage happy long in the futures contracts. The Dow was up 16% for the year. Going into 2026, there's some important factors here. One is the market, by historic measures, overpriced. Yes, it was all about tech this year. So part of the right answer was be all about tech, be all long all the time. That wasn't much fun in April when the Magnificent Seven were down nearly 30%. It's a hard trade to hold if you're all equity, all long. What is the solution if the market overall is overvalued? However, economic growth, third quarter, 4.3%. According to the Atlanta Fed, this quarter, 3%. Those numbers significantly above average growth for the U.S. economy. And here's a headline most people missed. All right, government shuts down, Bureau of Labor Statistics, Bureau of Economic Analysis, all upset because they got furloughed for a few weeks, 6 weeks actually. So they just batched all the numbers together, finally coughed them up in mid-December. But there was something most people missed. For the month of October and November, inflation ran at 0.2%. That's 0.1% per month, less than 1.25% annualized. That is a great inflation number. In fact, it's very rare. I know that slope of the curve, trailing 12 months, 2.7%. Okay, fine. But if you take the fact that economic growth accelerated, deregulation, AI productivity, helping companies. Profit projections for this year are double digits. That's the environment we enter 2026. A lot of companies won't be worth overpaying for, right? We cited examples, CoreWeave, Oklo. Those are two examples of companies that are in danger of a Polygon type gone. Now, let's go look at some of the individual components here. We're saying deep value is the place to look. That would be dividend companies with a catalyst. Now, this is a low-cost ETF, not a recommendation for your portfolio and not without price risk, but when you come down and get a plan, then we'll be more specific. You can do that at networthradio.com or themcgowangroup.com. We're easy to find. Now, Victory has a great fund. I like it, and it represents deep value. If you take these companies, look at the cash flow they generate, look at the catalyst that they have, you have growth and a high return. If you own the whole company, generally you've got a good forward rate of return if their cash flow continues the way it is. So you're not grossly overpaying. You don't have to worry about getting out of Polygon or CoreWeave at the right time. All right, here we go. 66%. This is a smelly old tobacco company. What happened? Nicotine pouches, and we bought them at a 7% yield back in February. Here, we got a total return, nuclear, 59%. That was good. It was much higher. We should have sold it all right there and bought it back right here. We're working on our timing at the investment committee each week where we decide the model portfolios. That's why you want us on your side. Look at this, 40% from eBay. This is like an old tech, boring company, kind of like Dell, but a low multiple and a catalyst. And that ended up having a good year too. All right, here we've got 3M. That's a boring old blue chip. We're looking for boring old blue chips that are so low in price that we know will do pretty well if we hold them for a while, and we're going to get paid real cash while we wait. Now, what's another favorite category? Pipelines. This was just a respectable 8%. I know that lagged the equity market, but you get a big dividend, and all that natural gas is either going to West Texas for data centers or liquid natural gas exports plus internal demand in the U.S. with a nice little growth rate. That is one of the deep value sectors that could be appropriate for a portfolio, and our model portfolios included. Here's a clue. Oil's down at 56, and ExxonMobil did 15% total return for the year, 14.8. Wow. Well, that natural gas catalyst, do not underestimate that for 2026. How do you build that into a portfolio? Would love to show you. I'm Spencer McGowan, your financial weatherman, president, McGowan Group Wealth Management, serving affluent families right here from the Crescent in Dallas. A team of 10, the team that cares. Come see us for the office tour. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You could see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.